So what we're looking at in everything we say, and I start pretty much every presentation with this, is we have to understand that the stock market is a story of cycles, basically overreactions in both directions. And we have this chart up here. This is actually psychologically what is happening, with our country here, and that's something that happens again and again and again. We're not going to dive deep into the behavioral finance side of things, but I do need to give people a little bit of an update here of what, just a reminder of what is happening in our country, and really our brains as we go through this. So there's two studies we have. Is first, Dr. Kahneman and Amos Tversky talked about how we had two brains, and you had the theory was that we had a fast brain that was make easy decisions, things like that, would give you the quick answers. And then his theory was that you had a slow brain that would take some time to work through hard decisions and then give you the best answer. But what they found in study after study was your brain is actually kind of lazy. It just likes to give you quick answers and then get back to resting. And so our brain does all these things called heuristics or mental shortcuts. The next part and the next theory that we focus on with behavioral finance is the studies from Dr. Thaler. And I love what he did because he started looking at how humans make decisions versus what he called econs or robots that are used in the economic models. And what he talked about was our ability to make decisions, how we price things out, how we make decisions with money, how bad we are as humans to understand odds and percentages. And then finally, how we are our own worst enemy. And the way that we think about things is that we almost have to create these barriers for us because we will make the bad decisions. And the example I always use is, despite all the theories and the studies we have on dieting, I will still eat an entire bag of M&Ms if I have them in front of me. I know it's bad for me, but as a human, we just do those things. And so that's something that we have to keep in mind. And so the two things to keep in mind is our brains will use shortcuts to make difficult decisions, and our actions do not always match what the economists say they should, which creates a problem. The other thing we need to understand, when I look at the economy, it's all based on fundamental economic research. And the economy comes down to really two questions. And you run all the numbers, and this is what it simplifies down to, is how many people are working, and how much are they producing? So in every economic debate, and I get it, we're going to talk about politics today, and there are social issues that are very important to different people, and I'm not going to judge anybody on their positions on social things. What I'm talking about politically and what it matters to the stock market is, in the economy, there's two questions. Will this increase the number of people working, and or will that make them more productive? Ideally, we'd like to see both of them working together. So that's all I care about. The other thing when we look at the economy is we want to break it down into four components. It comes down to consumer spending, investment spending, government spending, and then net exports. In other words, are we taking in more money from foreign sales versus what we're buying from foreign countries? How does that net out? When we look at things, this spreadsheet, or I'm sorry, this chart is showing us that what we have is really a consumer-driven economy. That's the breakdown. You can see that consumer spending has been and always has been a big part of it. The other thing that I find interesting is the government spending was a much greater part of our economy, and it continues to shrink. I know it's bigger than I personally would like it to be, but it has continued to shrink in terms of percentage of our output. So we have to keep that in mind. When you look at everything, it comes down to, you can see the breakdown. Consumers are a big chunk, so that's what we need to focus our most attention on when it comes to looking at the economy. Here's another way to break down economic growth, and you could see the contribution that each of these components have. And you could see that this contribution really comes down to consumers are a big part of it, but I have another special section on there where you look at imports versus exports. And normally you see, like if you look at the 30-year average or the long-term average, exports have been higher than imports. But one thing you'll notice over the last year is we've actually been importing a little bit more than we've been exporting. It's hard to see, it's a small blue line there, but it's helping in terms of economic growth a little bit. The other thing I want to point out on, and this comes with GDP reports, is it's the only economic or investment number I've seen where they take the last 3 months, the last quarter, and they essentially multiply it by 4 to give you an annualized rate. That's not how we do things with investments. The orange bars show what the official headlines are, and you could see that the the bars will fluctuate a lot. I want you to focus on the blue line and see that the sorry. You can see that the blue line is a little bit more smooth. That's the year-over-year change. In other words, how is the economy doing today versus a year ago? The other thing I want to point out is if you look at the period here that I circled, you see 2 orange bars in a row that were negative. And if you go back and remember, there was a lot of question in 2022 of, are we in a recession? Because the textbook definition says that a recession is a slowdown in output, usually indicated by 2 consecutive quarters of a decline in GDP. And so we had a lot of debate. You know, we had one side saying we're in a recession and nobody's saying we're in a recession. And the other side saying, no, we're not in a recession because we haven't fit the definition. So this is what they're talking about, is that circle there. So maybe technically we did have a recession, but you could see that blue line never got negative. So in other words, the economy did not decline on an annual basis, which is what typically happens during other recessions. And so that's where the confusion came in. And what I pointed out at the time was we weren't seeing a drop in employment. We weren't seeing the unemployment rate skyrocket, which is typically another sign of a recession. And that never happened. So maybe technically we already did have a recession, but the economy really did not contract like you would normally see during a recession. So as we move on, here's a way to take out all of the noise and just look at the blue line, which is the 1-year change. And then I threw in the orange line because that's the trend that we've seen. And you could see it's been slightly declining over there. And we're going to talk about why that is and what that means in terms of how economic policies from the 2 major candidates could impact this and what we should be looking for as voters as we evaluate their decisions. So I'm going to very quickly breeze through our economic indicators just to give you a feel for where we're at. Now, keep in mind, in the blog every month, and I always say it's typically the first Monday following the first Friday, because that's when we close our economic model from SEM. Essentially, after you've seen headlines that the jobs report came out, the following Monday, I'm going to post an economic update and dive into our leading indicators. But to set the feeling for today's talk, I wanted to go through the 4 different components in our leading economic indicator index, just so you get an idea of where we're at. So employment indicators, the ones we focus on, aggregate weekly hours. The reason we look at that is employers will increase hours if they're getting more activity, before they hire people. And if they're seeing less activity, they'll start to cut hours before they lay people off because it's very expensive to hire and fire people. And so you could see that the trend is definitely declined from the big burst that we had following COVID, but it's still decently positive. What we're very cautious of is if this indicator goes negative, we're going to probably be heading towards a recession. We're not there yet. The other one we look at is the employment number, and you could see that we obviously had a big surge following COVID, and when the economy opened up, we're still running at a very nice pace of employment growth. And I'm not going to talk about, some of the conspiracies about how the numbers are done. In general, other data backs that up, and that other data that we have is state unemployment claims, because you can't make it up. You have 50 states sending in saying this is how many people we had file for unemployment. It's something that in our models, we use a monthly number to kind of smooth out the week-to-week noise. And what I did on this chart was what we're looking at, and I flipped the axis so that in our brains, we think when something's going down, it's bad, and when it's going up, it's good. So this chart shows the percentage off the lows of unemployment. In other words, are we seeing more unemployment claims coming up, which is bad? So when the chart's going down, unemployment claims are going up. And traditionally, when we hit that 20% mark, that's when we want to be concerned. We're not there yet. We got there a little bit in the late fall, early spring. And you notice in the fall, we did have a pretty big sell-off in the stock market. And that's because unemployment claims were spiking. And the market short-term might say, oh, bad news for the economy is good news for the market because that means the Federal Reserve is going to cut interest rates. I'll talk about that here in a second. You don't want to see unemployment claims going up a lot because that snowball is hard to stop. And you're not going to stop that by cutting interest rates. So this is the indicator I watch. It comes out every Thursday. Our model smooths it out once a month. So that's one that I always pay attention to when it comes out. And if you're interested in what's happening in the economy, I would too. Every Thursday morning at 8:30 Eastern time, look for unemployment claims. Which direction are they going? If you see 4 weeks in a row where unemployment claims are going up, that's not very good news for the economy. Consumer indicators. I mentioned 70% of our economy is consumers. Consumer spending's just blown me away. Keep in mind this is aggregate spending, the overall spending in our economy. And so we're dealing with a consumer that still, at least according to the numbers, is happy spending money. And it's slowed down a little bit, but it's still a pace that we've not seen during past economic expansions during this century. The other thing we look at is service business activity. This is one that I watch very closely because our economy has shifted to a service type model. And the problem with service jobs is I call them easy come, easy go. So it can be a little bit more volatile. So we look at service business activity as a leading indicator to say, are things slowing down? And they were slowing down in the spring by quite a bit. I should say late. I'm from Arizona, originally. So I think of spring as being, February and March. But we were seeing a slowdown in February and March. And now you're starting to see service businesses are actually seeing a nice pickup in activity again. So again, not saying we're heading into a recession just yet when you look at that indicator, but the one that concerns me is consumer sentiment, basically surveys of how do you feel as a consumer. And the fluctuations in this chart are amazing. From a big picture standpoint, consumers have never recovered the great feelings we had back in the year 2000. You could see prior peaks in our economy in 2004 and 2007. We finally, as a country, started feeling pretty good about things at our peak this cycle in February 2018. And then again, we peaked out a little bit just before COVID. And it's interesting to see some of the peaks here. We had a valley in April 2020. That's when President Trump had just come out and said things are looking horrible because, he's from New York and a lot of his friends were dying. And that was kind of the bottom in sentiment. And things started picking back up. We started feeling better about things all the way until April 2021. And ironically, that's when the last stimulus hit. And then after that stimulus check, you could see our feelings as a country plummeted right up until June 2022. And incidentally, that's when we started to see the big jump in inflation, when it was 8 or 9%, start to finally decline into the 7%, 6%, and start to go down. But then we've had a noticeable spike down. We peaked in March of this year, and it's spiked down, and you could see consumers are pretty pessimistic right now. That's going to play a role in how they vote. That's going to play a role in how they spend money. And retail sales numbers came out for May, and it's showing that consumers are starting to really cut discretionary spending at what they call fast casual restaurants, and like Applebee's, Chili's, Five Guys, things like that. So inflation is still pinching people, even though inflation growth has come down some, it's still going up. And that's a concern that we have for the economy. Looking at investment indicators, we watch manufacturing indicators because even though we're not a manufacturing country, we still see if consumers pull back their spending on big ticket items, that's a leading indicator that things might not be so great. And we've seen this is our primary indicator that's saying our economy could be in trouble, and it's one that we watch very closely. Capacity utilization, that's the percentage of our manufacturing capacity that we're using as a country, and you could see that that's declining to the point we had a nice uptick, and now it's starting to come down again. So that's also a concern. The other thing that we're really paying attention to is housing, because we saw a really strange reaction in housing where the pandemic led to this surge in the real estate market. Well, that activity is now starting to wane, and you're starting to see building permits really start to drop. And so we like this indicator to use because there's so much economic activity that surrounds the building of a house, not just the money and the man hours that goes into it, but just what happens around a new housing community in terms of new businesses and new spending. And the fact that that's going down is definitely a red flag for our economy. And then finally, the last set of indicators we look at is government indicators. And despite what people have been saying about money and being tight, it really isn't. And this first chart I have up there is our measure of money supply, and it's still high. And I believe it's high because you have money market funds that SCM also loves utilizing are paying a really nice 4.5%, 5% rate. And so it's a nice place to store cash. So money's not really tight right now. It's a lot more attractive to earn 5% on a money market account or a CD than it is to invest. And so the government, the Federal Reserve, is running into a problem where money really isn't tight. And so that's kind of hurting them in terms of lowering inflation. Speaking of inflation, interest rate yield curve, I'm not going to get into it today because we just don't have time to do it, but the yield spread is not normal right now. Normally, long-term rates will be higher than short-term rates. When it doesn't, that indicates pessimism from the bond market in terms of the economy. It also, as we're seeing, is pessimism in terms of the Fed's ability to mask inflation. Because inflation, if it gets going for too long, that just erodes the value of your bond payments. And so we've seen this yield curve inversion. And again, we'll wait to talk about whether or not we were in a recession until after the fact. That's just the way recession indicators work. We probably saw a minor recession in 2022 where we saw those two consecutive quarters, but it wasn't enough to really reset things. And I think the jury's still out on if we're going to have a recession as indicated by the yield curve. It is something that we continue to watch. The other thing that we continue to watch is the Fed funds rate. This is really what the Federal Reserve controls. The Fed does not control long-term rates. The Feds do not control the mortgage market because that is set by the free market. And the mortgage rates will not come down until the bond market believes that the Fed has control of inflation. And what I have is a couple notes here. First of all, the Fed tried to cut rates aggressively. First, they raised rates to end the bubble. And then when the bubble popped, they started cutting rates, but it didn't really matter. We still hit a recession. The other thing I like to point out is the reason we still hit a recession is it takes 9 to 12 months for one change in Fed policy to finally filter through to the economy. And we still haven't felt the full force of the current interest rates. That's still cycling through our economy. And it's going to be cycling through our economy until early 2025. And we might start to see things break. And just because they start breaking and the Fed cuts rates doesn't mean they're going to be able to save it. So keep that in mind when you listen to people say, oh, hooray, the economy is getting bad, so the Fed's cutting interest rates. And I simply think that's not going to be the case. Here's our dashboard. Again, we posted on the Monday following the jobs report as an update. You can see it's a pretty mixed bag. The way we use it at SCM is in our dynamic models. And we've had a lot of fluctuation since 2022, especially last year and this year, where we went from bearish and it said, oh, things are looking better. And then they said, no, they're not. We were bearish briefly. We're kind of in a neutral stance. And my subjective opinion is all the noise we have out there from the different indicators is a good place to be neutral. In other words, you don't want to place a bet up or down right now, kind of let things play out. And that's what our model is doing right now. But I think critically what we need to pay attention to is inflation. And here's something, I didn't plan on spending a lot of time on this, but I know it is a topic that's going to come up in the debates. It's going to come up on your social media feeds. And what people misunderstand, myself included, is yes, inflation rates are coming down, but prices are not coming down. That's deflation. So we're still seeing prices go up for food and gas and things that we buy and rent and insurance and everything else. But what the Fed's trying to do is push that price change to 2%. So your $10 hamburger that's going up there, the Fed would prefer it only be $10.20 next year, not $10.50. And so that's kind of the target that the Fed is going after. And so yes, it still hurts because inflation hurt a lot of us. And then prices are still going up and you say, what in the world's going on? And I'm not going to talk politics on that, but it's a huge economy and it was broken, and the solutions to fix it really caused terrible inflation. And I circled here a few of the lines. Our 5-year average rate of inflation now is up to 4%. And that's all come very recently. But if you look at the long-term averages, we're just now barely getting above 2% long-term. So what I remind people of is, back in 1992 when I worked at Subway, with tax, I paid for my foot-long BMT $4.23. Subway, up until 2021, had a $5 BMT footlong. So we essentially had no inflation from 1992 until 2021. And now all of a sudden that $5 footlong is $10. That hurts. But if you smooth that out over 20 or 30 years, that's an average rate of inflation. Somehow businesses were squeezing out all the profits they could and kept prices low. And then we had 20 years worth of inflation in about 18 months. And that hurts. But focusing on what the Fed is looking at, the number that I always do is by the way, we're using PCE, not CPI, because the PCE is what the Federal Reserve uses. It's a little bit smoother. This band here kind of highlights the monthly changes we need to get to in order to have 2% at the bottom or 3% at the top inflation. And it's leveling off at levels that are above 2%, so above what's comfortable for the Federal Reserve. So I would say don't bet on a Federal Reserve rate hike or rate cut until we get below that. If we start to have a bunch of these bars above, there's a chance the Fed could raise rates because they can't have inflation reemerge at 3-4% annualized rates. So the other thing real quickly, and I put these in the blog usually once a month, the manufacturing prices paid and the services prices paid, when they're above 50, that's inflationary pressure on our economy. And that's something we have to work on. The other thing, and we've done charts on this, hopefully when we share this out on social media and in our blog, we'll get the link. I did an entire presentation talking about the K-shaped economy. Basically, from the beginning of COVID, I identified if you were able to do your job on a laptop, you probably ended up better off than people who could not do their job on a laptop. Yet, most people who kept their job and worked from a laptop received stimulus money. They received all this money, and they didn't really have anything to spend it on because the economy was shut down. So it caused our economy to break. The people on the lower end did not get enough money to cover the income lost. So they were hurting, and they're still hurting. And that's what I believe we're seeing in the consumer sentiment numbers is they don't align with consumer spending because the upper part of the K, by the way, the top 40% of Americans income-wise received 65% of the stimulus money. And that includes PPP loans, employee retention credits, things like that that business owners received. 65% of the stimulus money went to the top 40%. And so that's why we're seeing this big disconnect in how people feel about the economy. And again, we'll share the link to this video. Courtney, make sure when you send out the replay, you get the link to the K-shaped, because the economy definitely is broken, and it's something that we need to understand as voters of why people are having different experiences. But finally, before we start getting into what the meat of things that I wanted to talk about on the economy is, let's revisit this potential GDP equation. Remember, I always ask, will this policy increase the number of workers, help them produce more, or worse, will it decrease the number of workers or cause them to produce less? But what we're missing is we haven't been able to grow to our potential for about 40 or 50 years. And so when you look at it, this chart of potential GDP, which is the solid line, and actual GDP, which is the dashed line, you see a gap. And the reason being, and I'll talk about here in a minute, is you could see the shrinkage of our labor force has been pulling down economic growth for quite some time. And productivity has really not been that great. And when you sum those two together, we've had a declining rate of growth for quite some time. And looking at it is we're just not hitting our potential. And so you might ask why. And the reason being is this equation has to have a little algebra in there, because going back to what I talked about as far as our economic components is we have to subtract out net exports and interest expense. Because think of it like if you were a business, or your household financial statements is you have income coming in, but if you have money going out to other people that's not generating revenue for you, that's a subtraction on your overall income. If you're working more hours, if you've got a bit better job, but you're paying money out in interest, that's less money you have. And so we've had this potential up here, but yet we're subtracting out money we're sending to other countries to buy stuff. And we're subtracting out interest expenses because we're paying for things that we already bought. And so the way I think of debt is it's future spending brought forward. Not all debt is bad. If debt is used for investment, think of your mortgage, that can be good because you're investing in something that's going to provide future value. You're buying something with borrowed money that's helping you not pay somebody else's mortgage. So that kind of debt is not bad. But if I use a credit card that I can't pay off to go to a concert, yes, I had fun, but that's not helping me make more money. Well, it's the same thing with the government. And you can kind of see this dashed line is GDP growth. For the longest time, we had more economic growth than our country had debt. And then you could see somewhere in the early days of Ronald Reagan, we started using a lot of debt to stimulate growth. And you could see kind of where it went exponential, where we just kept adding more and more debt. That snowball just kept going down the hill in terms of interest expenses. And then I drew a line where the housing crisis was, because you could see households and corporations deleveraged, but the government actually accelerated the leverage that they had. And so we have to keep that in mind. Our economy is not growing out potential because we're sending more money than we're selling to overseas companies. And we keep increasing our debt load where it's not turning into future growth because interest expenses are going out. So let's turn now to politics. And before we get there, I'll use the same disclaimer that I've always used. I'm a registered independent because of my personal beliefs, all financially driven, is that neither side represents who I believe, because we're not seeing true fiscally conservative policies from the Conservative Party, and I believe there's some things economically that the other party is doing that are damaging. So if you're registered with either of those parties, I probably will offend you, and that's not my purpose, because I love our country. I love that we can have differing opinions and different people, but based on your political position, I may offend you. I'm not stating my opinions here. I'm going to show you some data and what my opinions are as an economist and my analysis of an economist based on only the data, and I'll let you make your own conclusions. But here's what the data shows. This chart, the green line is GDP, our economic growth, and the red line is government debt. And I put a box in there to show what happened when we had the debt ceiling crisis of 2011 and what happened in the later years. It did nothing in terms of our use of debt. We shut down our government a few times. We had S&P downgrade the US Treasuries because of the chaos that was happening in Washington. And we had everybody vowing to cut debt just to keep things going. And you can see how debt has skyrocketed. I put in red, again, not a political statement, but just for highlight purposes. The red is what we saw happening under the Trump administration. And you could obviously see when COVID happened, but even before COVID, the acceleration of debt was faster than economic growth before COVID under Donald Trump. You could see the acceleration we saw during COVID, but then even after the lockdown had ended, we kept using debt to stimulate our economy under President Trump. And then under President Biden, we've seen debt continue to go at a very steep pace. And I don't have the line on there right now, but you could see it's not much faster than what we saw in the last year that Donald Trump was president. So both parties have increased debt, and you could see how slow economic growth has been because of that. So who is responsible for the debt? Let's just look at the numbers. If you look at the growth of debt since 2000, based on the president in office, 55% of the debt has been from Democrats, but 45% has been from Republicans. That's just based on the president. If you look at the control of Congress, you could see we're worse off when we have a split Congress than if we have one side or the other. You could see when Republicans had full control of Congress, we didn't see a lot of debt added relative to what's happened when Democrats or Republicans were in charge. But what's really interesting is when you look at based on control of Congress and the White House, because we can't spend money without all sides agreeing, the House, the Senate, and the president. Most of this debt has been driven by a split government where we haven't had an agreement between the White House, the House, and the Senate. So most of the debt comes when we split things. And, there's two definitions of compromise. Compromise, one is agreeing to find a solution that's palatable to both sides. The other definition of compromise, and I brought this up during the debt ceiling circus, both in 2011 and then the solutions that they brought in 2021, which is compromises to put yourself in danger. And I believe that's what we see happening is both sides have realized, hey, if we keep spending money, we'll keep control, we'll keep our jobs. So we're going to keep spending money. So both sides, by compromising, have caused a big divide and a big share of the debt that we've added as a country. If you want to break it down in terms of presidencies, we have to look at the annualized rate of change. And a lot of people are surprised when I say Ronald Reagan actually ushered in this debt, because you could see when he was president, the percentage change in debt was the highest it's been in my lifetime. And H.W. Bush, his vice president and then president for 4 years, kept it going. Bill Clinton was the only one of all these presidents who actually did something in terms of not increasing debt at a very fast rate. He still increased it some, but he was the only one, and he was a Democrat. And then you had a Republican with George Bush, who added debt at almost the same rate as President Obama did. Donald Trump actually increased it faster than Obama and George W. Bush. And on a percentage basis, during his 3 years in office so far, President Biden actually has increased debt at a lower rate than Obama, Trump, or George W. Bush. Again, not a political statement, but that's just what the data shows. That that's just what's happening is Trump increased debt at a faster rate than Biden. Now, obviously, we had COVID, but Trump signed those stimulus bills, and when he didn't have to, but he did. And so when we say that one person is worse off for the debt than the other, the data just doesn't bear that out. Let's look now at where it comes from, because we'll start hearing a lot of things about wasteful spending. And so I've looked at this in terms of if I'm a business owner or if I'm a person trying to balance my personal checkbook, and I look at just what's coming in. And in 2023, this is President Biden's budget, and you had income, corporate, and excise tax receipts of $2.8 trillion. If you look at where that money went, you had defense, 1.1 trillion, interest expenses, 650 billion, welfare, 544 billion, and that comes out, and I put that out there, cash welfare, food stamps, unemployment benefits, workers' comp, housing supplements, and this does not exclude, or I'm sorry, this doesn't include Medicaid, and then other spending. We almost balanced our budget. We were so close to running a balanced budget on these categories. And if you ask most Americans, they would say, okay, cool. Because theoretically, Social Security and Medicare is supposed to be paid with separate taxes. Income and corporate and excise taxes are supposed to be going to running the government. The entitlement program, Social Security and Medicare, are supposed to be funded by payroll taxes. So theoretically, we almost balanced our budget when you look at just what income taxes and corporate taxes are supposed to cover. However, when you look at Social Security and Medicare, you see that FICA receipts were only 1.6 trillion. That didn't even cover Medicare and Medicaid. And by the way, we only pay in about 2%, 2.5% into FICA for Medicare, and then your employer doubles that. We're paying 7.6%, I'm sorry, 5.2 or whatever percent into Social Security for 7.6% of every paycheck, and then your employer doubles that. We're not even covering Medicare and Medicaid payments. So that's the shortfall. 1.6 trillion is coming out of us having to be borrowed from Americans to cover Social Security and Medicare shortfall. Neither candidate is telling you that. And we have to say it. There is not enough money to fund Social Security and Medicare. Now, you might say, but wait, Jeff, we put this in the trust fund. It's been sitting there for 20, 30, 40, 50 years. We'll just get it back from the trust fund. The problem is Congress, beginning in the late 70s and then re-upped by every Congress since then, said, we have all these dollars sitting in this trust fund, and then we're over here borrowing money to fund our deficit. Why wouldn't we just borrow money from the trust fund? And so that's what they started doing in the late 70s, and they just kept going. And so our borrowing was really low until they got to the point and they said, oh, wait a second, we're not bringing in enough money from current workers to cover what we promised retired workers, so we have to borrow money. We're not taking out enough money to pay back those IOUs. And so we're increasing the amount of money that we have to pay. So when you look at the total budget of the US government, you see the problem. 4.4 trillion of tax receipts, counting FICA, corporate income taxes, and excise taxes. Those receipts only cover Medicare, Medicaid, Social Security, and defense. We have to pay our interest on debts. So unless we cut something from these categories, we will not be able to balance the budget. Let me say that again. We will not balance the budget unless we cut from defense, VA benefits, Social Security, Medicare, and Medicaid. Because mathematically, we could cut transportation, education, other spending, which, by the way, I put other spending in there. So when a candidate says we just need to cut wasteful spending, this includes police, fire, law, the court system, prisons, legislative expenses. Remember, everybody says, oh, we're paying Congress too much. You could see how small that bar is on this chart. I agree we're paying Congress too much, but that's not the problem. Economic development, the Department of Agriculture, the Department of Energy, the EPA, and then interest on government debt from interagency, things that technically we could write off, but that would just cause a bigger shortfall in Social Security. But that other spending goes away. Welfare is a pretty big chunk, but we could eliminate that and still run a deficit, because you see how big interest expenses are. You see how small education and transportation expenses are. And by the way, education and transportation, if spent correctly, are investments, should be investments in our future growth. That could be good debt. And I take no offense. I don't want to offend anybody who's on Social Security or Medicare. That is not an investment in future growth of our economy. That's just paying somebody who worked and is now retired and is spending that to live in retirement. We're not going to solve our country's debt problems unless we tackle defense, Social Security, Medicare, and Medicaid. Because if I subtract out VA benefits, by 2025 or 2026, the interest on our debt is going to be greater than what we're spending total on the military. Current military, not VA benefits, but the current active duty military spending will be surpassed by defense spending. Social Security and Medicare will no longer have enough money to pay current recipients. It will be insolvent by 2020, 2033, 2034, depending on when you look at it. There's a lot of problems with the way they do that budget, including assuming 3% economic growth and only 2% inflation, but well, not today's topic. We have to solve this debt problem because interest is going to keep becoming a bigger and bigger portion of it. We can't just tax the rich. We can't just cut wasteful spending. That would not fix any of this unless we're willing to attack these three in a logical basis. And neither candidate will do that because the lobbyists and the commercials will say, this candidate wants to take away your Social Security. This candidate wants to ruin your retirement. So anybody who dares mention reforms to Social Security and Medicare will not win election because us as voters believe that Social Security and Medicare cover their costs, and they don't. They believe that there's a trust fund that's sitting there with the money when the trust fund is full of IOUs. So every shortfall, last year was $1.6 trillion, has to be borrowed back. We have to pay back those IOUs. And we see where interest expenses are going. It's not a good situation. So let's look at it in a different way. Here is the 2023 spending and then the 2025 budget. You could see interest is just getting higher and higher on that chart. It's not a good situation that we're in. And again, cutting welfare, cutting other spending, maybe it needs to be looked at that that's not the solution. The analogy I used back in 2011 when they were the last time even thinking about the budget was that would be like me struggling to pay a $2,000 mortgage and saying, well, honey, if we cut our $20 Netflix subscription, I think we'll be good. We have to attack the big areas. And this chart shows the big areas: Medicare, Medicaid, Social Security, defense, and VA benefits. Because interest on debt is starting to surpass spending on defense, and we can't keep going in that direction. Here's another way to look at it: government spending percentages. Again, this is what the data says, annualized rate of change. You could see Reagan and H.W. Bush spent money like crazy. George W. Bush spent money like crazy in terms of that. And then Donald Trump again, because he had the COVID stimulus checks, under his watch. They all spent money quickly. That's going to be different than what you're hearing people say, is people believe that Republicans don't like spending money. But the data shows that Republicans do spend money. And again, not a slam on Republicans, but the data says they will spend money actually faster than the Democrats do if you look at these charts. And again, there's other reasons that go into that. They believe that the way they're spending money is an investment, but it hasn't panned out so far that way because, again, we're compromising. We're putting ourselves at risk by just trying to make everybody happy, and that's just not working. So let's look at the stock market because that's most important. Is which party do they love the most? Well, let's first look at the presidents and how has the market done under those presidents. And you could see Bill Clinton, and again, I'm not a political statement. This is just what the data says. I believe he inherited a pretty nice trend in technology, and he cut the deficit the most. He cut spending the most, and he had the best stock market growth out of any president in my lifetime. But the close second was Donald Trump. You can't argue with that. Trump's barometer of his performance was the stock market, and he was extremely friendly to the stock market. But we saw that he also spent a lot of money when it came to debt. Joe Biden's performance has not been as great, but the only president where we've seen negative performance was a Republican. So don't assume that a Republican will be the be-all, end-all for the stock market, like a lot of people do, or that a Democrat means the stock market's going to crash, because it did quite well under President Obama, did extremely well under President Clinton. Both Obama and Clinton had actual better performance than Ronald Reagan. And nobody would have told you that when they were elected, that was going to happen. But looking at it a different way, and we have two sets of data because we have some data that will go back to 1901. We have other data that goes post Great Depression to kind of see. But what you'll see is the stock market loves a split Congress. And it really hates when there was a Republican president in a split Congress, because that's what happened with George W. Bush and a few other, Hoover and a few people like that had dismal performance. Overall, the best case scenario tends to be a split. And that comes out if you look at since 1933, the best performance for a market is if we have a divided Congress, because they can't dramatically change things one way or the other. Now, obviously, that's bad for our debt situation because they'll just keep compromising to try to make the other side happy. But what I want people to understand before we open it up to questions is this is not a mandate. Our voting is controlled by the independents. We have a two-party system, but we have a system where more people are like me, where they say, neither party truly represents who I am, so now I have to pick a side. If you look at the party affiliation, you could see since 2010, we had a slight drop in independence, but both parties are losing people to the independent side. And what you found happening in the last elections, and I highlighted those 2016, 2020, and today, is the independents have gotten bigger. Yet, whichever party wins, that party is going to declare it a mandate. I'm sorry, it is not a mandate if only 30% or 28% of the country identifies with your party. Because what happened in 2016, if you look at the data, and I shared this after the 2020 election, Hillary Clinton lost enough independents that President Obama had won in 2012 to swing the vote to Donald Trump. So the independent vote went from Obama to President Trump. Then in 2020, that same size of independents that Trump won from Obama swung to Joe Biden. And that was enough to sway the election because only 31% of Americans were Democrats during the election. So what's going to decide this election is not the far left or the far right. It's whichever candidate attracts the most independent votes. And that's why the polls will go in all these different directions. The other thing, and I don't like text slides, but I think this is important. We'll definitely put it out there in the replay and the blog. But this is based on my studying and experience. Economic policies will not change on day one. Now, we've learned the last 3 presidencies, the executive order pen on day one will be going very furiously. And we saw Donald Trump do it. We saw Joe Biden do it. And then the courts came back and said, well, hold on, buddy, that's illegal. They can change regulatory guidance and then we'll have it challenged in court. We're not going to see major game-changing policies happen on day one, which means you do not need to react today based on who you believe is going to win in the White House and in Congress. Things will not change on day one. The other thing to keep in mind, and I've seen this again and again and again, campaign talking points do not become the priority when the election's won. Because right now, obviously, both Trump and Biden have locked up the primaries. They did it. Basically, all they had to do was sign up and they won the primaries. But as we get closer to the general election, remember, they have to attract independent people. And we've seen Trump wavering on abortion stuff. We've seen Trump wavering on taxes. We've seen Biden wavering on tax policies, and he's trying to buy independent voters with loan forgiveness. All these talking points do not become the priorities once they won election. Because remember, you cannot pass economic policies without both sides. There's one reason Wall Street loves a split Washington, D.C., is because they're not going to get earth-shattering changes to policies unless both sides agree. So that's where they believe compromise is a good thing. Again, on the debt side, that means it's a bad thing for the long term. The other thing you have to understand, the stock market looks forward. They're more in tune than any of us are in terms of what a Republican or a Democrat control of Congress will mean, what a Republican in the White House versus a Democrat will be. They'll start talking to their big institutional investors and anticipating before. So before changes happen, they're going to price that in. So you and I sitting there and saying, well, I think this person is really bad or good, therefore I'm going to make changes to my portfolio, is not going to work. We've seen it again and again and again. Remember, the stock market prefers a split in Washington. But the other thing I have to remind people of, and I didn't put this in writing, I should, is please don't let your political opinions influence your investment decisions because of all these things up here. The other thing is, if we see something happening, and I heard a comedian talk about this, they were talking about, they were reading an article and it said, 85-year-old marathon runner tragically dies. And the comedian said, if the average life expectancy is 78, anybody dying over the age of 78 isn't a tragedy, it's expected. And I'll be as blunt as possible. There is no guarantee that either of these people could be the person who's on the ballot. And when that happens, we're going to have all kinds of chaos. So we have to keep that in mind. The other thing, as a recap, the way our brains work is we're like, oh my gosh, we have all these things happening in Washington. What am I going to do? Oh, I don't know how to handle this. And so our brains start taking shortcuts and they say, this party's good, this party's bad. This party means my taxes are going up. This party means my taxes are going down. We start doing these shortcuts. I hope the data today showed you that we don't know. We honestly don't know. The data says a split in Washington is better for the stock market. The data says it's also bad for the deficit. The data says Republicans actually spend more than Democrats. The data says the market sometimes like Democrats better than the Republicans. We just don't know. So please don't use your political opinions to influence what's happening. We always remind people every decision comes down to what is your financial plan saying? What is your cash flow strategy? that shouldn't change. If it does change, that would be because economic policies happened. They changed the law. We're not going to have November 5th or 6th, whatever day the election is, and wake up the next morning and go, oh my gosh, taxes are going up December 31st. One, that can't even happen. Two, if the president you believe is going to raise taxes, they have to get it passed in Congress. So the earliest that'll happen would be December 31st, 2025, effective in 2026. So your financial advisor is going to have plenty of time to adjust to the changes in Washington. Your investment manager is going to have plenty of time to adjust what the law is changing to, that you do not need to make a change now. I hope that's understood. Is we will have time to make changes based on the outcome. You should not be making changes today based on who you think is going to win and what you think the outcome of that will be. The other thing I want to point out, we put this in the blog every week, a lot of noise on here. The main thing I'm sharing is we will make adjustments. Even our growth portfolios can scale down stocks. We base it on the trend, not our opinions of who's going to win or lose in November, what's going to happen to taxes. We let the institutional investors get told by Wall Street which way they think it's leaning, and then we climb on that trend up or down. We've had a really nice uptrend. We're loving these returns. I don't think it's a bet on who's going to win. I think it's just a bet that Wall Street believes it's not going to be a mandate and we're not going to see earth-shattering changes either way. You might not like the outcome, but it might be okay for your portfolio. We don't want to see you go all the way to cash because you're afraid of the outcome. We will take care of that based on your financial plan. So I am right up against the hour. I want to leave time for Q&A, but I understand, it might be people's lunchtime. They might be just starting their day on the West Coast. We're going to split this presentation up so it'll be easier to digest. So if you have to hop off for the Q&A session, I won't have my feelings hurt. I appreciate it. It seems like everybody stayed through the hour, so that's great. So I will remind you before you hop off, if you don't want to stick around for Q&A, go to semwealth.com. I share my thoughts every Monday. We call it Monday Morning Musings, MMM. We have it there at the bottom of the screen. You hit the Market Insights, and you can see the SEM Traders blog. If things start getting really dicey, I will post more than once a week. But a lot of times it's just going to be, here's what we see happening. Here's what our portfolios are doing. So if you're interested there, there's also a subscribe button there. More personal finance related things, and we'll be posting things about the economics and the election throughout. TikTok, Instagram, Facebook, LinkedIn, you can see all of our social stuff there. So that's how you get the latest thoughts from us. Always feel free, if you're working with SEM, to talk to your advisor, and we can schedule a call as well.